Again, a morning stream. Yeah. What's up, guys? How's life? Uh, Okay, so yeah, I'm not as late as yesterday. Or am I? No, I've been like sitting here for like the past 15 minutes again scrolling Twitter. Yesterday that was my excuse, right? Yeah, Twitter. Okay, I won't say Twitter is fun, but it's engaging, man. At least, like, yeah, and it's fun. Okay, I'll say it. It's fine. Twitter is fun actually. Okay, by the way, yesterday I just wanna know something happened yesterday, bro. On stream, right? It like automatically became muted, and I don't know why. Is there a shortcut? I yesterday checked the hotkeys of OBS. I didn't find anything. I'm having this writing pad here, right? So like part of it is on the keyboard. So there could be a reason like I accidentally pressed some key, causing it to uh, mute the stream. Maybe that's what happened. And hopefully it won't happen. And you guys let me know if it automatically gets muted. Yesterday, I think around like half an hour, more than half an hour, I think. I was reading the book to no one. No, no, I was reading, but no one was hearing anything. But it's fine, right? I mean, it's fine because no one was there. Teresa Bernard, hi. Roman is saying keep going. Yeah, man, I'll keep go, bro. Thanks, bro. Can you give me a shout out? Edits 1 to 2. Yeah, shout out, bro. Shout out to edits 1 to 2. Hey, who's gonna? Okay, fine. I mean, if you think it's worth it, man. Fajar Maulana is asking, are you Pakistani? I mean, close. Like, basically, Indian, right? So, India, Pakistan, Bangladesh. Same, but different. I mean, you can say. Don't stop. Yeah, man, I won't say. Roman Blackwell. Yeah, I can say your name, bro. Roman. Roman Blackwell. Yeah, I won't stop, bro. I won't stop. Now, you know what? I did stop in between, but then again, I started. Okay, so yeah, by the way, guys, I just wanna let you guys know we are reading this book, so we are almost at the end. I think like one chapter is remaining. So the title, right? Title and the thumbnail, I put the second book. So we'll finish this and then we'll continue the other one. Fine. So the last chapter, I think last or second last chapter. Wait, let me see. Yeah, 24. So today I subscribe you dog, keep going. Hey, thanks, man. Thank you, bro. Okay. So chapter 24, alternative monetary system. Yeah, around this, like alternative monetary systems and all, we'll discuss further in detail on the next book, right? I'm writing in like an awkward angle. I told you, right? The writing pad is actually overlapping with the keyboard, and I don't want to accidentally again press some key and like mess up the settings. I mean, nothing else changed so far. The only problem yesterday was the mute button. I don't know. I don't even know. Do I have a mute button set up? Let me check. If I press M, it didn't get muted. That's the thing, right? I don't know what key was the problem. Okay. Yeah, guys. Alternative monetary systems, cryptocurrencies, and blockchain technology. Cryptocurrencies and blockchain technology are revolutionizing the financial sector and challenging traditional monetary systems and central banks. Cryptocurrencies such as Bitcoin and Ethereum operate independently of central banks and governments, using decentralized network and blockchain technology to verify transactions. One of the main advantages of decentralized currency is their potential to increase financial inclusion, allowing anyone with an internet connection to participate in the global economy. They also offer increased transparency and security, as transactions are recorded on a decentralized ledger that is immutable and resistant to tampering. However, there are also potential drawbacks to decentralized currencies. Their lack of regulation and anonymity can make them vulnerable to criminal activity such as money laundering and tax evasion. The volatility of their value can also make them risky investments with fluctuations in value that can be difficult to predict or control. Moreover, widespread adoption of cryptocurrencies as a replacement for traditional currencies could pose a significant challenge to central banks, as it could limit their ability to control monetary policy and stabilize the economy. This is because cryptocurrencies are not subject to the same regulatory oversight and interventions as traditional currencies. Furthermore, the rise of cryptocurrencies and decentralized finance has also led to concerns about the environmental impact of their energy intensive mining processes, as well as the potential for increased inequality. As early adopters and large holders of cryptocurrency could potentially gain significant financial advantages. In summary, while cryptocurrencies and blockchain technology offer exciting potential for innovation and increased financial inclusion, their impact on traditional monetary system and central banks remain a subject of debate and concern. As with any new technology, it is essential to weigh the potential benefits against potential risks and challenges before embracing it as a viable alternative to traditional monetary systems. Local currencies and complementary currencies. Okay, like the alternative. Second alternative is local currencies and complementary currencies. Local currencies and complementary currencies are alternative monetary systems that exist alongside the mainstream national currencies. These currencies are created and used within a local community or region and are designed to support local economies by keeping money circulating within the community. One type of local currency is the community currency, which is a form of currency that is only accepted within a specific geographic area, such as a town or city. These currencies are often created and managed by local organizations or community groups and can be used to support local businesses and promote economic development. Another type of local currency is the time bank, which is a system that allows individuals to exchange services and skills with one another without the use of money. In a time bank, members earn time credits for the services they provide, which can then be used to receive services from other members. Complementary currencies are designed to work alongside national currencies rather than replace them entirely. One example of a complementary currency is a carbon currency, which is a currency that is based on the reduction of carbon emissions. Individuals or organizations that reduce their carbon emissions can earn carbon credits, which can then be used to purchase goods and services from other members of the system. One potential advantage of local and complementary currencies is that they can help to keep money circulating within a community. something changed. As you can hear me, right? No, something actually changed in the OBS. It's not muted. It's not muted. Okay, I think it's fine. It's yeah, there was some like pop-up randomly coming up and mm, this can help to support local businesses and promote economic development. Additionally, these currencies can provide a sense of community and promote social cohesion. However, there are also potential drawbacks to these systems. One challenge is the difficulty of ensuring that the currency is widely accepted and used within the community. Additionally, the use of local and complementary currencies can create barriers to trade with outside communities or regions. Finally, the creation and management of these systems can be complex and require significant resources and expertise. Next is bartering and sharing economies. Bartering and sharing economies have been on the rise in recent years as people seek alternative forms of exchange that prioritize community and sustainability over profit. Bartering is a system of exchange in which goods and services are traded directly without the use of money. Sharing economies, on the other hand, involve the sharing of resources such as housing, transportation, and equipment among individuals and communities. One of the primary benefits of bartering and sharing economies is that they promote community building and reduce waste. By sharing resources and goods, individuals and communities can reduce their environmental footprint and build stronger relationships with one another. For example, a group of neighbors might share tools and gardening equipment, reducing the need for each household to purchase their own and leading to less waste and consumption overall. Bartering and sharing economies also have the potential to be more equitable than traditional forms of exchange. In a bartering system, goods and services are valued based on their utility and usefulness rather than their market price. This can help to reduce inequality by providing individuals with access to goods and services that they might not be able to afford in a traditional monetary system. However, there are also challenges associated with bartering and sharing economies. For one, these systems can be difficult to regulate and monitor, which can lead to issues of fairness and accountability. Additionally, there is the risk that bartering and sharing economies could perpetuate existing power dynamics, with some individuals or communities having greater access to resources than others. Overall, while bartering and sharing economies have potential to support community building and reduce waste, they are not without their challenges. As these alternative forms of exchange continue to evolve and gain popularity, it will be important to consider these benefits and drawbacks and work to create systems that are both equitable and sustainable. Next is open banking and fintech. Open banking and fintech are two rapidly growing areas in the financial industry that are changing the way we think about banking and financial services. Open banking refers to the practice of allowing third party providers to access banking data services through APIs, while fintech encompasses a broad range of financial technologies, including mobile banking, payment platforms, and robo advisors. One of the most significant impacts of open banking and fintech is their potential to disrupt traditional banking models. These technologies are making it easier than ever for consumers and businesses to access financial services and are challenging traditional banks to innovate and offer new products and services in response. However, there are also challenges associated with these new technologies. One of the most significant is the issue of privacy. As more financial data is shared among different providers, there is a risk that this data could be compromised or used for nefarious purposes. It is therefore essential for regulators to ensure that adequate safeguards are in place to protect consumers' privacy and prevent fraud. Another challenge is the potential for fintech and another challenge is the potential for fintech to exacerbate existing forms of inequality. For example, some fintech platforms may be biased against certain groups of people, such as those with low credit scores or those who live in underprivileged areas. In addition, some critics have argued that the use of algorithms in lending decisions can reinforce existing biases and discrimination. Despite these challenges, there are many potential benefits to open banking and fintech. These technologies have the potential to increase financial inclusion by making it easier for underserved populations to access banking services. They can also support innovation and competition in the financial industry, which can ultimately benefit consumers by lowering costs and improving service quality. In conclusion, open banking and fintech are transforming the financial industry in many ways, from enabling greater access to financial services to challenging traditional banking models. While there are certainly challenges associated with these technologies, there, there are also significant opportunities to improve financial inclusion, increase innovation, and promote competition in the industry. It is up to regulators, policymakers, and industry players to work together to ensure that the benefits of these technologies are realized while minimizing the risks. Next is community currencies and mutual credit systems. Community currencies and mutual credit systems are alternative forms of exchange. Mr. Colombiano, hey, what's up, man? Uh, Etil 5 Drayik. I don't know what does it mean, Mr. Colombiano. These systems allow communities to create their own currencies, which can be used to facilitate local trade and strengthen local economies. Community currencies can take many forms, including time banks, local currencies, and loyalty programs. Time banks allow individuals to trade services with each other, with each hour of service provided being equal to 1 hour of credit. Local currencies are designed to be used within a specific community with the goal of promoting local trade and keeping money circulating within the community. Loyalty programs offer rewards to individuals for supporting local businesses and can be used to incentivize local spending. Mutual credit systems are similar to community currencies, but they are designed to be used by businesses rather than individuals. In these systems, businesses can trade goods and services with each other using a system of credits. For example, if a business provides services to another business, they would receive a certain number of credits that they could then use to purchase goods or services from other businesses within the system. One of the main benefits of community currencies and mutual credit system is that they can help to strengthen local economies by promoting local trade and keeping money within the community. These systems can also help to create a more equitable economic system by providing a way for individuals and businesses with limited financial resources to participate in the local economy. However, there are also challenges associated with creating and implementing community currencies and mutual credit systems. One of the main challenges is governance and regulation. These systems need to be carefully designed and regulated to ensure that they are secure and that they operate within the legal framework of existing financial system. Another challenge is adoption and acceptance. Community currencies and mutual credit systems rely on widespread adoption to be successful, and it can be difficult to get individuals and businesses to adopt these systems. Education and outreach are key to overcoming this challenge and building a strong community of users. Overall, community currencies and mutual credit systems have the potential to be powerful tools for building more resilient and equitable local economies. However, creating and implementing these systems requires careful planning, governance, and education to ensure their success. Chapter 25: The Future of Financial Power and Its Impact on Society. The role of finance in the modern economy and its influence on society. Finance plays a crucial role in the modern economy and has a significant influence on the society. It encompasses a broad range of activities, including banking, investment, insurance, and financial planning. Finance allows individuals and businesses to manage their resources efficiently and make informed decisions about saving, borrowing, investing, and risk management. One of the most significant ways in which finance influences society is through the allocation of capital. Capital allocation refers to the process of determining how financial resources are distributed among various industries, companies, and individuals. This process can have a profound impact on economic growth, job creation, and innovation. Moreover, finance provides individuals and businesses with access to credit and other financial products that allow them to invest in education, housing, and entrepreneurship, among other things. By providing this financial support, finance has the potential to promote social mobility and economic development. On the other hand, the influence of finance on society is not always positive. Financial crises and economic recessions can have severe consequences for individuals and communities, leading to job losses, bankruptcies, and social unrest. Moreover, the concentration of financial power in the hands of a few individuals and institutions can exacerbate income inequality and contribute to social and political instability. In recent years, concerns about the role of finance in society have prompted calls for greater regulation and oversight of the financial sector. There have also been calls for greater transparency and accountability, particularly in relation to issues such as executive compensation and the use of financial derivatives. Overall, the role of finance in modern economy and its influence on society is complex and multifaceted. While finance has the potential to promote economic growth and social mobility, it can also have negative consequences if not managed properly. Therefore, it is essential to ensure that the financial sector is regulated effectively and operates in a way that benefits society as a whole. The potential benefits and drawbacks of continued financial innovation. Financial innovation refers to the development of a new financial instruments, technologies, and business models. While financial innovation can bring about significant benefits, it can also have drawbacks and unintended consequences. One potential benefit of financial innovation is increased efficiency in the allocation of capital. For example, the development of securitization has allowed for the pooling of assets and creation of new investment products, which can increase liquidity and reduce risk. Additionally, the advent of digital payments and mobile banking has increased financial access for unbanked populations, allowing for greater financial inclusion. However, financial innovation can also lead to increased complexity and risk. The 2008 financial crisis, for example, was in part due to the development of complex financial instruments such as collateralized debt obligations or CDOs that were poorly understood and mispriced. The widespread adoption of algorithmic trading and machine learning in finance also raises concerns about systemic risks such as flash crashes or market manipulation. Another potential drawback of financial innovation is its potential to exacerbate income inequality. Financial innovation can create winners and losers, with those who have access to the latest financial technologies and tools benefiting more than those who do not. Additionally, financial innovation can create incentives for short term gains and speculation rather than long term investment and sustainable growth. Furthermore, financial innovation can also create new forms of ethical challenges such as privacy concerns and the potential for discrimination in the use of AI and other advanced technologies. For example, the use of AI in credit scoring could inadvertently discriminate against certain groups of people. Overall, the benefits and drawbacks of financial innovation are complex and interrelated. While innovation can increase efficiency and access to financial services, it can also create new risks and exacerbate existing inequalities. It is important for regulators, policymakers, and industry leaders to balance the potential benefits and drawbacks of financial innovation, and promote a responsible and sustainable approach to financial innovation. The impact of new technologies on financial power and control. New technologies have potential to fundamentally transform the financial sector, altering the balance of power between traditional financial institutions, regulators, and consumers. The rapid pace of technological change has already had a significant impact on the financial industry. With the emergence of new fintech players, digital currencies, and blockchain technology challenging traditional models of finance and shifting the locus of control away from the established institutions. One of the key impact of new technologies on financial power and control is the democratization of access to financial services. Digital platforms and mobile apps have enabled millions of people around the world to access financial services that were previously out of reach, such as online banking, peer to peer lending, and crowdfunding. This has the potential to promote financial inclusion and reduce inequality, particularly in emerging economies where traditional financial institutions may be less accessible. However, new technologies also pose significant risks to financial power and control. The use of algorithms and artificial intelligence in the financial sector has raised concerns about the potential for automated decision making to reinforce existing biases and discrimination. Additionally, the increasing use of big data by financial institutions raises significant privacy concerns, particularly in light of recent data breaches and cyber attacks. Blockchain technology, which underpins digital currencies such as Bitcoin, has the potential to revolutionize the way financial transactions are conducted. The decentralized nature of Bitcoin networks means the transactions can be conducted without the need of intermediaries such as banks or clearing houses, reducing transaction costs and increasing transparency. However, the lack of regulation and oversight in digital currency space has also led to concerns about fraud, money laundering, and other illicit activities. Overall, the impact of new technologies on financial power and control is complex and multifaceted. While they have potential to promote financial inclusion and democratize access to financial services, they also pose significant risks in terms of privacy, security, and discrimination. As such, it is critical that regulators and policymakers take a proactive approach to managing the risks associated with new technologies and promoting responsible innovation in the financial sector. Next, the potential consequences of continued centralization of financial power. The centralization of financial power refers to the concentration of financial resources, control, and decision making in the hands of a few large financial institutions. This trend has been ongoing for several decades and has significant implications for the global economy and society. While some argue that centralization leads to greater efficiency and stability, others point to the potential risks and negative consequences of continued centralization. One potential consequence of continued centralization is the creation of too big to fail institutions. These institutions are so large and interconnected that their failure could have catastrophic consequences for the entire financial system, as seen during the 2008 financial crisis. In addition, centralization can lead to a lack of competition as smaller firms are unable to compete with larger, more powerful institutions. This can result in higher prices, lower quality services, and reduced innovation. Centralization can also exacerbate income inequality as the benefits of economic growth and financial prosperity are concentrated in the hands of a small group of individuals and institutions. This can lead to social and political unrest as those who feel left behind by the financial system become increasingly frustrated and disillusioned with the status quo. On the other hand, proponents of centralization argue that it leads to greater stability and efficiency in the financial system. Centralized institutions can pool resources and expertise, making it easier to manage risk and respond to economic shocks. In addition, centralization can lead to economies of scale, reducing costs and increasing efficiency. However, the potential risks and negative consequences of continued centralization cannot be ignored. It is essential to strike a balance between the benefits and drawbacks of centralization and to ensure that the financial system remains stable and accessible to all. One approach is to increase competition in the financial sector, promoting the emergence of new players and technologies that can challenge the dominance of existing institutions. Governments can also play a role in regulating the financial sector, promoting transparency and accountability, and ensuring that the benefits of financial innovation are shared more widely. The role of government in regulating and shaping financial sector. The role of government in regulating and shaping financial sector is a critical one. Governments are responsible for ensuring that financial systems operate effectively, efficiently, and in a manner that protects the interests of consumers and society as a whole. The financial sector is crucial to economic growth and stability, and therefore, government intervention is necessary to ensure its proper functioning. One of the primary roles of government in the financial sector is to regulate financial institutions and activities. Regulations are in place to protect consumers and investors from fraud, manipulation, and other unethical practices. In addition, regulations aim to maintain stability in financial markets, prevent systemic risks, and promote competition. Governments also oversee the licensing and supervision of financial institutions, ensuring that they operate within the law and comply with regulations. Governments also play a significant role in shaping the financial sector by creating policies and frameworks that promote financial inclusion and innovation. Financial inclusion policies aim to ensure that all members of society have access to financial services, including those who are traditionally excluded from the financial system, such as low income individuals and small businesses. Governments also promote innovation in the financial sector by supporting research and development, providing funding for startups, and creating regulatory framework that encourage innovation. My lips keep drying up, bro. I think it's the tea, like just drinking black tea, right, in empty stomach, and maybe that's why. Black tea actually dehydrates you a bit. Maybe that's a reason. Plus, I'm speaking right continuously. Another important role of government in the financial sector is crisis management. Governments must be prepared to quickly and effectively to financial crises such as the 2008 financial crisis. In such cases, governments may need to provide emergency liquidity to financial institutions, recapitalize banks, and implement other measures to stabilize financial markets. Overall, the role of government in regulating and shaping financial sector is crucial. By ensuring financial institutions operate within the law and comply with regulations, governments can protect consumers and investors from fraud and unethical practices. By promoting, yeah, yeah, nose is acting up. By promoting financial inclusion and innovation, governments can help to ensure that the benefits of financial system are available to all members of society. And by being prepared to respond to financial crisis, governments can help to maintain stability in financial markets and prevent systemic risk. The potential for alternative financial systems to emerge and disrupt traditional models. In recent years, there has been a growing interest in alternative financial systems that aim to challenge traditional models of finance. These systems are often designed to be more decentralized, transparent, and accessible than traditional finance, and they seek to address some of the shortcomings of existing financial systems. One example of an alternative financial system is decentralized finance or DeFi, which is built on blockchain technology and allows for decentralized and trustless financial transactions. DeFi platforms offer a range of financial services, including lending, borrowing, and trading without the need for intermediaries like banks. This can potentially reduce costs and increase access to financial services for individuals who may be underserved by traditional financial institutions. Another example of an alternative financial system is community currencies, which are designed to be used within a specific geographic or social community. Community currencies can help to keep money within a local economy, support local businesses, and promote community building. They can also potentially reduce the impact of economic downturns as people continue to exchange goods and services even if traditional currency is scarce. However, there are also potential drawbacks associated with alternative financial systems. One of the main challenges is ensuring their stability and security, as many of these systems are still in the early stages of development and are vulnerable to hacking and other security issues. Additionally, some alternative financial systems may not be well regulated, which can increase the risk of fraud and other illegal activities. Another challenge is achieving widespread adoption of these systems, as they often require significant changes in behavior and infrastructure. For example, community currencies may require businesses to accept them as payment, and decentralized finance may require individuals to have a certain level of technological literacy to participate. Overall, the potential for alternative financial systems to disrupt traditional models is significant, but it is important to approach these systems with caution and ensure that they are well designed, secure, and regulated. Additionally, it will likely require a collaborative effort between governments, businesses, and individuals to support the development and adoption of these systems. The relationship between financial power and income inequality. Financial power and income inequality are closely related. Financial power refers to the ability of individuals or organizations to control and influence the allocation and distribution of financial resources, while income inequality refers to the uneven distribution of income among individuals and households within a society. Financial power can exacerbate income inequality by enabling those who possess it to manipulate financial systems and structures to their advantage, often at the expense of those who do not have the same level of access to financial resources. This can result in concentration of wealth and resources among a small percentage of population, leading to greater income inequality. Furthermore, financial power can also influence policy and decision making processes, allowing those with financial power to shape economic policies and regulations in their favor. This can lead to a further concentration of wealth and resources, exacerbating income inequality. On the other hand, the absence of financial power can also contribute to income inequality, as those without access to financial resources may be limited in their ability to create wealth or achieve financial stability. This can create a cycle of poverty and limited opportunities, perpetuating income inequality. Alternative financial systems and models such as community currencies, mutual credit systems, and peer to peer lending have the potential to disrupt traditional financial models and empower individuals and communities with more control over financial resources. By promoting financial inclusion and democratizing access to financial resources, these alternative systems may help to reduce income inequality. In addition, policies and regulations that promote transparency, accountability, and fairness in the financial systems can also help to mitigate the effects of financial power on income inequality. This can include measures such as progressive taxation, consumer protection laws, and antitrust regulations. Overall, the relationship between financial power and income inequality is complex and multifaceted. While financial power can exacerbate income inequality, alternative financial systems and effective regulation can help to promote greater financial inclusion and reduce inequality. The potential for consequences of a future financial crisis and how society can prepare for it. Financial crises have been an inevitable part of modern economic history, and their consequences can be devastating for individuals. businesses, and entire societies. In the wake of the 2008 global financial crisis, there has been renewed focus on the potential consequences of future crises and how society can prepare for them. One of the primary consequences of a financial crisis is the disruption it can cause to the economy. When financial institutions fail or are severely impacted, credit markets can freeze up, leading to a contraction in lending and a slowdown in economic activity. This can result in job losses, business failures, and general decline in living standards. Another consequence of a financial crisis is the potential for widespread social unrest. When individuals and families lose their jobs or homes, they can become desperate and angry. This can lead to protests, riots, and even political instability. To prepare for a future financial crisis, society must take a proactive approach. This could involve strengthening regulation of financial institutions and markets, improving transparency in financial transactions, and promoting greater financial literacy among the general public. Another way to prepare for a future financial crisis is to promote greater economic resilience. This could involve encouraging individuals and businesses to save more, diversifying the economy to reduce dependence on specific industries or sectors, and investing in education and training to improve workforce skills and adaptability. Finally, society can prepare for a future financial crisis by building stronger safety nets. This could involve strengthening social safety net programs such as unemployment insurance, increasing access to affordable healthcare, and providing targeted support to vulnerable populations such as low income families and the elderly. In conclusion, the potential consequences of a future financial crisis are significant, and society must take proactive approach to prepare for them. By strengthening regulation, promoting financial literacy, building economic resilience, and building stronger safety nets, we can reduce the impact of future financial crises on individuals and society as a whole. The role of education in promoting financial literacy and empowerment. Financial literacy is a critical life skill that is essential for personal and societal financial stability. Without it, individuals can make poor financial decisions that can result in significant personal debt and societal economic instability. Therefore, the role of education in promoting financial literacy and empowerment is crucial. One way that education can promote financial literacy and empowerment is by introducing financial concepts and skills early on in life. Schools can include personal finance courses as part of their curriculum to teach students about money management, budgeting, credit management, and investing. This can help students to develop good financial habits early on and make informed financial decisions as they grow older. Financial literacy education can also be provided through community workshops and events. These events can cover topics such as debt management, retirement planning, and home ownership, among others. These events can help individuals better understand their financial options and empower them to make better decisions. In addition, financial institutions can also play a role in promoting financial literacy by providing educational resources to their customers. These resources can include seminars, webinars, and informational brochures on financial products and services, investment options, and budgeting and saving tips. By providing this education, financial institutions can help their customers make informed decisions that can lead to better financial outcomes. Finally, financial literacy education can be an essential tool in closing the wealth gap between different economic groups. Financial knowledge and access to financial services are often unequal, leading to significant disparities in wealth accumulation. By providing financial education and resources to underserved communities, financial institutions and educators can empower these individuals to build wealth and increase their financial well being. In conclusion, the role of education in promoting financial literacy and empowerment is essential for personal and societal financial stability. By introducing financial concepts early on, providing community workshops, offering educational resources, and closing the wealth gap. Education can help individuals make informed financial decisions, reduce financial stress, and build long term financial security. So, now it's conclusion. Guys, we finished the book. So, we are at conclusion, and that's it, right? Yeah. Conclusion and epilogue. The Capital Game, the evolution of financial power, has taken us on a remarkable journey through the intricate web of finance and its profound impact on society. We have explored the historical foundations of financial power, witnessed its evolution through technological advancements, and examined its role in shaping economic systems and income inequality. Throughout this book, we have delved into the challenges and opportunities presented by alternative financial systems, the potential consequences of continued centralization of financial power, and the critical role of government regulation in shaping the financial sector. We have also recognized the potential consequences of future financial crisis and the importance of preparing for them. Moreover, we have highlighted the vital role of education in promoting financial literacy and empowerment, equipping individuals with the tools to navigate complex world of finance. By understanding the unethical considerations and impact of financial power, we can work toward a more equitable and sustainable society. The capital game encourages us to question traditional models and explore innovative approaches to finance. It emphasizes the need for transparency, accountability, and responsible decision making in the financial sector. Hey, Timothy Kyle Gaming. Hey, what's up, bro? Hi, Tim. What's up? Good morning. As we conclude this journey, it is crucial to remember that financial power is not an isolated force. It is intricately linked to the well being of individuals, communities, and nations. By embracing the lessons learned from history, technological advancements, and societal challenges, we can shape a future where finance is a force for positive change and inclusive prosperity. May this book serve as a guide, inspiring conversations, fostering critical thinking, and empowering individuals to navigate the ever evolving landscape of financial power. Let us embark on the path to a more equitable, sustainable, and enlightened financial future. Together, let us continue to play the capital game with wisdom, empathy, and deep understanding of its profound implications. Good morning, too. Yeah, Tim. How's life, bro? How's your channel going? We haven't checked your channel in a long time. Timothy Kyle Gaming. Going well. Doing good. I have a second channel, by the way. Nice, bro. Nice. Good, good, good. Wait, you made a this video. Don't ask why is dark. I don't know how to fix it. Minecraft Story Mode episode 1. Hey, that's good. Why aren't you continuing it? No, this one seems to like get good views. So that's one thing, right? If you find something which is working, just continue doing that more, bro. Episode 1, we need episode 2. Good. Okay, so epilogue is like the end of the book. As we reach the epilogue of Capital Game, it is a moment of pause and reflect the journey we have undertaken. We have traversed the realms of, oh yeah, I continued on stream. Oh, nice, nice. No, no, then like chop it up, like make clips also. Why only continue it on stream? That'll be nice. I'm just suggesting, bro. We have traversed the realms of finance, exploring its historical foundations, dissecting its complexities and examining its impact on society. Our exploration has revealed the dynamic nature of financial power and its far reaching consequences. Through this book, we have come to appreciate the interplay between financial systems and the intricate web of human lives. We have witnessed the transformative power of technological advancements, the challenges of income inequality, and the potential for financial innovation to shape our future. In exploration, we have encountered a myriad of perspectives from economists and policymakers to scholars and activists, each offering their unique insights and critiques. We have examined the role of central banks, alternative financial systems, and the importance of financial literacy. We have grappled with the ethical considerations that underpin financial decisions and pondered the implications of a rapidly changing global landscape. As we conclude this journey, we are reminded that the evolution of financial power is an ongoing process. It is a game that continues to be played, shaped by the actions and choices of individuals, institutions, and societies. The future of finance lies in our collective hands, and it is our responsibility to ensure that financial power is harnessed for the betterment of all. The capital game has been an exploration, a call to action, and an invitation to engage in critical discourse. It is our hope that this book has sparked conversations, challenged assumptions, and inspired readers to delve deeper into the complex world of finance. May this epilogue serve as a reminder that the story of financial power is not confined to these pages. It's a story that unfolds every day, in every transaction, and in every decision. Let us approach this story with a sense of responsibility, compassion, and a commitment to creating a more just and equitable financial landscape. As we bring our journey to a close, let us remember that the evolution of financial power is not a game to be won. Alright, see you later. Yeah, Tim, I'll see you later, man. Bye. As we bring our journey to a close, let us remember that the evolution of financial power is not a game to be won, but an ongoing pursuit of balance, fairness, and prosperity for all. Thank you for joining us on this exploration, and may the insights gained from the capital game shape your understanding of finance and empower you to navigate its complexities with wisdom and discernment. Breck Grainger, which is me. So guys, we finished this one. This was the capital game. Then yeah, we concluded and all right. The conclusion and epilogue like completely covered the overall topics. So, okay, so now let's go into the next book, the Currency Conundrum. So yeah, we are reading this one now. So this one is more technical. So in capital gain towards the end we discussed about alternative systems and how alternative systems could be uh, better in some ways, but you know what I'm saying, right? Like to the existing current traditional system, we learned how that evolved, which is existing right now, and how alternatives can work. But in this one, we'll dive deeper into economic theories and all, which which talks about all the different systems and their impacts on all the things around us. So this has 40 chapters. This is a big book actually. So Capital Game was around how many pages? 192 pages, and Currency Conundrum is around not around exactly 330 pages, like almost like 30% more. I mean 30% more. That's okay. But like number of chapters, but like towards the end, right? Most of the chapters are like very small, like few pages, but I have like divided them separately so that we can have like uh, clear cut borders between the topics. So okay, so let me write this. The Currency Conundrum. Currency Conundrum. I'm not gonna read the acknowledgements and all. Preface. We read the preface. Okay, money is a universal language that speaks to the heart of human civilization. It is a tool that facilitates transactions, incentivizes innovation, and fuels economic growth. Yet, the history of money is also a history of conflicts, crises, and controversies. The question of how to create and manage a stable, equitable monetary system is a puzzle that has puzzled philosophers, economists, and policymakers for centuries. This book is an attempt to explore the complexities of monetary systems and provide a comprehensive analysis of the various factors that shape their evolution and impact. The Currency Conundrum is a journey that takes us through the history of money, from its origins in ancient civilizations to the emergence of modern financial institutions and digital currencies. The book is divided into 42 chapters, each of which delves into a specific aspect of monetary systems, from the mechanics of debt money to the role of central banks, from the challenges of globalization to the opportunities of innovation. We examine different economic models from the gold standard to the post industrial economy and discusses the pros and cons of different monetary policies, from inflation targeting to quantitative easing. Throughout the book, we also explore the ethical dimensions of monetary systems, from the impact of income inequality to the role of corruption in economic growth. We analyze the environmental consequences of economic growth and the challenges of balancing economic development with environmental sustainability. The Currency Conundrum is not a technical manual for experts, but a guide for anyone who wants to understand the complex and fascinating world of monetary systems. It is a book for students, academics, policymakers, and general readers who seek to deepen their knowledge and broaden their perspectives. We hope that this book will help readers navigate the shifting landscape of monetary systems and economic models and to gain a deeper appreciation of the challenges and opportunities that lie ahead. Ultimately, our goal is to contribute to a more informed and engaged public discourse on one of the most fundamental issues of our time. Breck Grainger, which is me. Prologue. Money is an enigma that has fascinated humanity since its earliest days. We have used shells, beads, gold, and paper to represent it. We have borrowed, lent, spent, and saved it. We have fought wars, built empires, and created civilizations based on it. Yet, we still struggle to understand its complexities and implications. In this book, we embark on a journey to explore the conundrum of currency, the intricacies of monetary systems, and the challenges of economic models. We examine the evolution of money from its origin as a means of exchange to its modern day manifestation as a complex financial instrument. We delve into the mechanics of debt money systems, bond money systems, and debt free money systems and analyze their impact on the economy and society. We study the history of interest and usury, income tax, and the relationship between debt money and government spending. We explore the role of central banks, inflation, and the gold standard in shaping monetary systems. We investigate the impact of globalization, automation, and technology on economic models and job markets, and analyze the effects of income inequality, climate change, and social welfare programs. As we journey through the pages of this book, we seek to unravel the mysteries of money, economics, and human behavior. We hope to shed light on the complexities of monetary systems and economic models and to provide a framework for understanding the challenges and opportunities they present. We invite you to join us on this exploration of the currency conundrum and to engage in a critical reflection on the future of money and the economy. Introduction. Money is an essential aspect of our daily lives. We use it to buy goods and services, to invest in our futures, and to build wealth. However, few of us stop to consider the complexities of monetary systems and the economic models that govern them. From debt based monetary systems to the gold standard, from fractional reserve banking to cryptocurrencies, the world of money is vast, intricate, and constantly evolving. This book, The Currency Conundrum, exploring the complexities of monetary systems, seek to provide readers with an in-depth understanding of the many factors that shape monetary systems and economic models. Through a comprehensive exploration of historical, political, and social contexts in which these systems emerged, we aim to shed light on the mechanisms that drive economic growth and development. Each chapter in this book tackles a different aspect of monetary systems and economic models, from the evolution of money to the impact of climate change on the economy. We examine the role of central banks and governments in shaping monetary policy, and we explore the impact of globalization and innovation on economic models. We also delve into the controversies surrounding taxation, social welfare programs, and the role of private banks in the monetary system. Our goal is to provide readers with a nuanced understanding of the complexities of monetary systems and economic models and to encourage critical thinking about the many factors that shape the world of money. Whether you are a student of economics, a professional in finance, or simply someone who wants to gain a deeper understanding of the economic systems that shape our world, this book offers a comprehensive and engaging exploration of the currency conundrum. Overview of monetary systems. Definition of monetary systems. A monetary system refers to a set of institutions, policies, and procedures that govern the creation, distribution, and exchange of money within an economy. It is a crucial component of any modern economic system, providing the means for facilitating transactions, promoting economic growth, and fostering financial stability. The primary purpose of a monetary system is to establish a medium of exchange that is widely accepted within a society. This medium of exchange, usually referred to as money, enables individuals to trade goods and services with each other without the need for a barter system. In addition to its use as a medium of exchange, money serves as a store of value, a unit of count, and a standard of deferred payment. There are different types of monetary systems that have been used throughout history, including commodity money, fiat money, and digital money. Commodity money is a form of money that has intrinsic value, such as gold or silver coins. Fiat money, on the other hand, derives its value from government regulation and decree and is not backed by any tangible asset. Digital money is a relatively new type of monetary system that uses digital technology to facilitate transactions. The choice of a monetary system has significant implications for economic growth and development, as it affects the efficiency of the financial system, the stability of prices, and the level of economic activity. Therefore, understanding the definitions and characteristics of monetary systems is essential for policymakers, economists, and individuals who seek to promote economic prosperity and stability. Functions of money. Money serves several critical functions within an economy, which are essential for the efficient operation of a modern financial system. The primary functions of money include serving as a medium of exchange, a unit of account, a store of value, and a standard of deferred payment. As a medium of exchange, money facilitates transactions between buyers and sellers by serving as a widely accepted means of payment. This function allows individuals to trade goods and services without resorting to a barter system, which would require a coincidence of wants between trading partners. As a unit of account, money provides a common measure of the value of goods and services. This function allows prices to be expressed in consistent and easily understood manner, which is critical for making informed economic decisions. As a store of value, money allows individuals to save their wealth for future use. This function is made possible by the stability of money's purchasing power over time, which allows individuals to defer consumption and invest in productive assets. Finally, money serves as a standard of deferred payment, allowing individuals to make payments at a future date. This function is critical for facilitating credit transactions, such as loans and mortgages, which are essential for economic growth and development. Overall, the functions of money are essential for facilitating economic activity, promoting financial stability, and fostering economic growth. The efficiency of the financial system depends on ability of money to fulfill these functions effectively, making it critical component of any modern economy. Historical development of monetary systems. The concept of money has been around for thousands of years, with the first known currency being used in ancient Mesopotamia around 2500 BC. Over time, monetary systems have evolved and taken on various forms, influencing by factors such as economic growth, political power, and technological advancements. In ancient times, barter was a common form of exchange where goods and services were traded directly between individuals. However, as societies become more complex, the need for a more standardized form of exchange became apparent. This led to the development of commodity money, where goods with intrinsic value such as gold, silver, and salt were used as medium of exchange. With the rise of empires and governments, fiat money was introduced, where the value of currency is not based on any underlying commodity, but rather on the trust and authority of the issuing entity. Paper money was first used in China during the Tang dynasty in 7th century, but it was until the 17th century that paper money became widely used in Europe. In the 20th century, digital money emerged with the advent of electronic payment systems such as credit cards, online banking. Today, cryptocurrencies like Bitcoin have gained popularity as an alternative form of digital currency. Throughout history, monetary systems have played a crucial role in facilitating economic transactions and fostering economic growth. The development of monetary systems has also been shaped by political and social factors, with governments playing a significant role in the management and regulation of monetary systems. Different types of monetary systems, example, commodity money, fiat money, digital money. Monetary systems can be categorized based on the type of money used within the system. Historically, different types of money have been used at different times, and each type has its own characteristics and features. The three main types of money used in monetary systems are commodity money, fiat money, and digital money. Commodity money is a type of money that has an intrinsic value, meaning that it has value beyond being used as a medium of exchange. For example, gold or silver coins are examples of commodity money. The value of commodity money is determined by the value of the underlying commodity. Commodity money systems were prevalent in the past, particularly in ancient civilizations such as Rome and Greece. Fiat money is a type of money that has value only because government declares it has value. Fiat money is not backed by any commodity, but is instead backed by the government's ability to enforce its value. Most modern economies use fiat money, which includes paper currencies and coins. Digital money is a type of money that exists purely in electronic form. Digital money can be used for transactions through electronic payment systems or cryptocurrency. It is decentralized, meaning that it is not controlled by any government or financial institution. Bitcoin is one example of digital money. Each type of money has its own advantages and disadvantages, and monetary systems can be designed around any of these types of money. The choice of money type can impact the stability, flexibility, and portability of the monetary system. The adoption of digital money has brought about new challenges and opportunities for monetary systems, particularly in terms of security and regulation. Characteristics and features of monetary systems. Example: stability, flexibility, portability. The characteristics and features of a monetary system are important factors that affect its effectiveness and sustainability. One key feature is stability, which refers to the ability of the monetary system to maintain a consistent value over time. This is crucial for businesses and individuals to plan and make investments with confidence. Flexibility is another important characteristic of monetary system, which refers to its ability to adapt to changing economic conditions. A flexible monetary system is able to adjust interest rates, money supply, and exchange rates to respond to changes in the economy, such as inflation or recession. Portability is also a key characteristic of a monetary system, which refers to its ability to be easily transferred and used across different regions and countries. A portable monetary system enables international trade and investment as well as facilitates cross border transactions. Other important features of monetary systems include divisibility, which enables transactions of varying amounts, and durability, which ensures that money remains usable over time. Additionally, the accessibility and security of monetary system are also important factors that affect its functionality and adoption. Overall, the characteristics and features of a monetary system play a crucial role in its effectiveness and ability to facilitate economic growth and development. It is important for policymakers to consider these factors when designing and implementing monetary systems in order to ensure their long term sustainability and effectiveness. Factors influencing the choice of monetary system. The choice of a monetary system is influenced by various factors that can differ from country to country or from one period to another. One of the primary factors is historical and cultural traditions, which can shape the preferences and attitudes towards different types of money. For example, societies that have relied on commodity money such as gold or silver for centuries may prefer a monetary system that maintains such commodities as a store of value. Another factor that affects the choice of a monetary system is economic stability. Monetary systems that are able to maintain price stability, avoid hyperinflation, and provide a stable investment environment are generally preferred by governments and investors alike. Governments may also choose a monetary system that helps them to control inflation, reduce debt, or promote economic growth. Technological advancements and innovations are also critical factors influencing the choice of a monetary system. As digital technologies continue to advance, digital currencies are becoming more prevalent, making them an attractive alternative to traditional forms of money. Digital currencies offer advantages such as faster and cheaper transactions, increased security, and broader financial inclusion. Finally, the global economy and geopolitical factors can play a role in the choice of a monetary system. Countries that are closely connected to global trade and financial markets may choose a monetary system that aligns with international norms and standards, while countries that face sanctions or other restrictions may choose a more isolated or self sufficient monetary system. Advantages and disadvantages of different monetary systems. There are several advantages and disadvantages associated with monetary systems. Commodity money such as gold and silver has been used throughout history and is still used in some societies today. The main advantage of commodity money is its intrinsic value, which makes it relatively stable and durable. However, its supply is limited, which can lead to deflation and hoarding. Moreover, high cost production Moreover, the high cost of production and transportation make it less portable. Fiat money, on the other hand, is not backed by any physical commodity but is instead based on the trust and faith in the government and central bank issuing it. This allows for a more flexible money supply which can be adjusted to meet the needs of the economy. However, it also means that its value is subject to inflation, which can erode purchasing power over time. In addition, there is always the risk of hyperinflation if the government prints too much money. Digital money, such as cryptocurrencies, is relatively new type of monetary system that offers advantages such as speed, security, and anonymity. It is also decentralized, meaning it is not controlled by a central authority. However, it is largely unregulated and its value can be highly volatile, making it risky for investors and consumers alike. Overall, the choice of a monetary system depends on a variety of factors, including cultural traditions, political stability, economic development, and technological advancements. Each system has its own advantages and disadvantages, and finding a balance between stability, flexibility, and portability is key to creating a successful monetary system. Importance of monetary systems for economic growth and development. Monetary systems play a crucial role in promoting economic growth and development. They provide a stable and predictable means of exchange that enables individuals and businesses to conduct transactions with confidence. When the monetary system is functioning effectively, it promotes the efficient allocation of resources, encourages investment, and stimulates economic activity. One of the primary functions of a monetary system is to provide a stable store of value over time. This helps to facilitate long term investments and planning by individuals and businesses. A stable and predictable monetary system also promotes international trade and investment as it allows for reliable exchange rates and reduces the risk associated with currency fluctuations. Moreover, monetary systems provide framework for financial intermediation whereby banks and other financial institutions can channel savings into productive investments such as new businesses or infrastructure projects. This helps to drive economic growth and development by creating jobs, generating income, and increasing productivity. In addition to those benefits, monetary systems also play a key role in controlling inflation and ensuring price stability. When a monetary system is able to maintain stable prices over time, it helps to prevent the erosion of purchasing power and enables individuals and businesses to plan for the future with greater certainty. Overall, monetary systems are essential for promoting economic growth and development. They provide the foundation for stable and predictable exchange, facilitate investment and financial intermediation, and to help control inflation and ensure price stability. Next is chapter 3, the evolution of money. So yeah, the this evolution of money, right? So this part we've discussed in depth on the last book. There were like multiple chapters, right, on the different parts of the evolution of money. But in this is all that is like condensed into one single chapter, and we don't go into that detail. Guys, I'll take a Small water break. Huh? I'll be back. I'll be back. 2 minutes. Okay. The evolution of money. Money is a medium of exchange that is widely accepted as payment for goods, services, or debts. It has been used by human societies for thousands of years and has evolved over time to become more sophisticated and efficient. The functions of money can be broadly classified into three main areas: a medium of exchange, a unit of account, and a store of value. As a medium of exchange, money facilitates the exchange of goods and services by providing a common standard of value that is easily recognized and accepted by buyers and sellers. Instead of relying on barter or other less efficient means of exchange, people can use money to obtain the goods and services they need and want. As a unit of account, money serves as a standard measure of value that can be used to compare the prices of different goods and services. This function of money allows people to make informed decisions about how to allocate their resources and helps to promote efficient economic activity. As a store of value, money allows people to save their wealth and use it at a later time. Money that is stored in a secure location, such as banks or investment account, can earn interest or appreciate in value, providing a means of preserving and accumulating wealth over time. Overall, the definition of money and its functions play a critical role in functioning of modern economies, providing a means of exchange, unit of account, and store of value that facilitates economic activity and promote growth and development. The origins of money. The origins of money can be traced back to the early stages of human civilization. Before the invention of money, people engaged in barter, exchanging goods and services directly without the use of a medium of exchange. However, barter was not a practical system, especially when it came to exchanging goods of unequal value or when the desired goods were not available in the vicinity. This gave rise to a need for a standardized medium of exchange, which eventually led to the development of money. The earliest forms of money were commodity money, such as seashells, cattle, and grain, which had inherent value and could be exchanged for other goods and services. As trade and commerce developed, precious metals such as gold and silver were increasingly used as money due to their rarity, divisibility, and durability. The use of precious metals as money was particularly important for international trade as they were easily recognizable and universally accepted. The origins of money can be linked to the development of writing, as early forms of money were often inscribed with symbols representing their value. This made it easier for trade and exchange of money, as it reduced the need for physical exchange and made record keeping easier. In summary, the origins of money can be traced back to the need for a standardized medium of exchange, which developed as a result of limitations of the barter system. The earliest forms of money were commodity money, which eventually gave way to precious metals such as gold and silver, and the use of symbols and writing helped facilitate its exchange. Barter economy and limitations of barter. Before the advent of money, people relied on barter systems as a means of exchange. Barter is an exchange of goods and services for other goods and services without the use of money. Barter was commonly used in ancient societies and was especially prevalent in modern economies where goods and services were the primary means of exchange. However, barter had significant limitations. One of the main limitations was the problem of double coincidence of wants. In a barter system, for a trade to occur, both parties must want what the other has to offer. This made transactions time consuming and inefficient, as it required extensive searching for a suitable trading partner. Moreover, barter was limited by the indivisibility and perishability of some goods. For instance, it was difficult to divide a cow into smaller units for exchange or store it for an extended period without it spoiling. This further restricted the scope of barter trade. Overall, the limitations of barter made it ineffective and inefficient means of exchange, leading to the development of commodity money as a more efficient and effective alternative. Commodity money is a type of money that is backed by a physical commodity such as gold or silver and has intrinsic value, making it more durable, divisible, and portable. Next, commodity money and its characteristics. Commodity money is a type of currency that has intrinsic value because it made from a valuable commodity. This type of money has been used throughout history and has included things such as gold, silver, salt, and tobacco. Commodity money was often used in ancient societies because it was recognized it was easily recognized and has had a consistent value. One of the main characteristics of commodity money is that it is a physical object that has value. This means that it can be easily traded for goods and services without the need for a centralized authority or government. Another characteristic is that the value of commodity money is based on the scarcity of the commodity it is made from. The rarer the commodity, the more valuable the currency. Commodity money also has the advantage of being durable and long lasting, making it ideal for use as medium of exchange. However, it can be difficult to transport and store large amounts of commodity money, especially in situations where the commodity is heavy or bulky. Despite its advantages, commodity money has several limitations. One of the main limitations is that the value of the currency is tied to the value of the commodity it is made from. This means that if the supply of the commodity increases, the value of the currency will decrease. Commodity money is also vulnerable to counterfeiting, which can lead to loss of value and trust in the currency. The emergence of coinage and its impact on trade. The emergence of coinage is an important milestone in the evolution of money. Coinage originated in the 7th century BCE in Lydia, a region in present day Turkey, and quickly spread through the Mediterranean world. The use of coins revolutionized trade by providing a standardized, portable, and durable means of exchange. Coins were made from precious metals such as gold, silver, and bronze, and their value was determined by the weight and purity of the metal. The use of coins eliminated the need for weighing and testing the value of commodities in trade transactions, making exchanges faster and more convenient. Coins also facilitated long distance trade as they were universally recognized and could be easily transported. The use of coins also had an impact on the economy and society. The minting of coins became a royal prerogative and helped to establish the authority of rulers. Coins also enabled the accumulation of wealth, which led to the emergence of a merchant class and the growth of commerce. The widespread use of coins contributed to the development of a money economy, where goods and services were exchanged for money rather than bartered directly. Overall, the emergence of coinage was a significant development in the history of money, as it provided a standardized and durable means of exchange that facilitated trade and economic growth. Next is paper money and its evolution. Paper money, also known as banknotes, is a form of currency that evolved from the use of commodity money such as gold and silver. It originated in China during the Tang dynasty in the 7th century and spread throughout the world. Guys, there are like two lizards on the wall. They are doing, I don't know what they're doing the Mexican standoff, bro. Are they gonna kill each other? I don't know what's happening. Lizards, bro, lizards. Mm-mm. Initially, paper money was a promise to pay a certain amount of commodity money, usually gold or silver, on demand. It was issued by banks and used as a convenient means of exchange, reducing the need to carry heavy coins. In the 17th century, the Bank of Sweden issued the first banknotes that were not backed by any specific commodity, but rather by the credibility of the issuing bank. The widespread use of paper money began in the 19th century with the introduction of national currencies. Governments began to issue paper money as legal tender, which means it must be accepted as a means of payment for goods and services. This made paper money more widely accepted and reduced the need for individuals to carry heavy metal coins. The evolution of paper money continued to the introduction of security features such as watermarks, serial numbers, and holograms. Yeah, bro, the lizard. Okay, there's a good chance they'll fall down. Let me scare them off. Just chilling there. Uh, the evolution of paper money continued with the introduction of security features such as watermarks, serial numbers, and holograms to prevent counterfeiting. In the 20th century, electronic payments and digital currencies began to emerge, further reducing the reliance on physical paper money. Today, paper money remains an important form of currency in many countries, although its use is declining as more people shift towards digital payments. Despite the evolution of money, paper money remains an important symbol of trust and stability in the global economy. Development of banking and credit systems. The development of banking and credit systems can be tracked back to ancient civilizations such as Mesopotamia, where merchants and traders deposited their money and goods with the temple for safekeeping. As trade expanded and merchants needed to transport large sums of money across long distances, early forms of banking emerged in ancient Greece and Rome, where money changers would exchange coins and offer loans to traders and merchants. In medieval Europe, banks began to emerge in the form of money lenders and goldsmiths who offered loans and stored valuables for a fee. With the rise of international trade in the 17th and 18th centuries, European banks played a crucial role in financing trade and investment, including the establishment of colonies and the slave trade. The development of banking and credit systems has played a crucial role in facilitating economic growth and development by providing individuals and businesses with access to credit and capital. Banks offer a range of services including savings accounts, loans, and investment products which enable individuals and businesses to save and invest their money, borrow for investment and consumption, and manage financial risks. However, the development of banking and credit systems has also led to concerns about financial stability and regulation, particularly in the wake of financial crises such as Great Depression and global financial crisis of 2008. As a result, governments and regulators have implemented a range of measures to ensure the stability of banking systems, including deposit insurance, capital requirements, and regulation of financial institutions. The rise of national currencies and their advantages. The rise of national currencies began in the 17th century when European governments started issuing their own currencies to replace the various forms of currencies that were in circulation. The advantages of national currencies are numerous. First and foremost, they provide a means of exchange that is accepted throughout a country, which greatly simplifies trade and commerce. This in turn facilitates economic growth and development. National currencies also provide a stable and reliable store of value. The fact that government is the issuer of the currency means that there is a certain level of confidence in the currency's stability, as it is backed by the government's ability to levy taxes and control the money supply. This stability makes national currencies an attractive form of savings for individuals and businesses. Another advantage of national currencies is that They can be used to finance government operations. Governments can issue bonds denominated in their own currencies, which can be sold to investors to raise funds for public works, infrastructure, and other projects. In addition, national currencies can be used to manipulate the economy through monetary policy. By controlling the supply of money and adjusting interest rates, governments can influence inflation, employment, and economic growth. Overall, the rise of national currencies has been a key factor in the growth and development of modern economies. They provide a stable and reliable means of exchange and store of value, as well as a tool for financing government operations and managing the economy. The impact of colonialism and imperialism on the global currency systems. Colonialism and imperialism played a significant role in shaping global currency systems. European powers that colonized other countries imposed their currencies and trade practices on their colonies, leading to a shift from local currencies and traditional trade to a global monetary system. This shift had significant consequences for the colonies, including economic exploitation and political subjugation. During the colonial era, European powers used their military might and economic power to control trade in their colonies. They imposed their currencies, trade practices, and institutions on the colonies, leading to a shift from traditional barter systems to a global monetary system. The colonizers used their currencies to control trade and accumulate wealth, while the colonies were forced to use them to conduct their economic activities. The impact of colonialism and imperialism on global currency systems is still felt today. The former colonies still face the economic challenges due to the legacy of colonialism, including underdeveloped financial systems, low levels of financial literacy, and limited access to capital. Additionally, many developing countries still rely on foreign currencies for international trade, which can lead to currency instability and vulnerability to external shocks. In summary, the impact of colonialism and imperialism on global currency systems was profound and far reaching. It contributed to the emergence of global monetary system, but at the expense of the economic and political autonomy of the colonies. The role of gold and silver in monetary systems. Gold and silver have played a significant role in the history of money and monetary systems. These precious metals have been used as a medium of exchange, a store of value, and a unit of account for thousands of years. In ancient times, gold and silver coins were used as currency and were highly valued for their rarity, durability, and aesthetic appeal. As trade expanded across regions and continents, gold and silver became the preferred means of payment due to their universal acceptance and liquidity. During the 19th and early 20th centuries, many countries adopted the gold standard, which pegged the value of their currency to a fixed amount of gold. This allowed for stable exchange rates and facilitated international trade. However, the gold standard was also criticized for its inflexibility and inability to adjust to the changing economic conditions. The role of gold and silver in modern monetary systems has changed considerably since the adoption of fiat money. While they no longer serve as the basis for the value of currency, gold and silver are still widely used as a store of value and a hedge against inflation and economic uncertainty. Many individuals and countries hold gold and silver as reserves to protect against currency fluctuations and financial crisis. In summary, gold and silver have been an integral part of monetary systems throughout history and continue to play a significant role in modern finance. The transaction. Wait, guys, now there are three lizards. What are they doing? I think they are having like some tribal war or something for territory. You know that, right? Like each lizard have like a territory around a particular light, and other lizard won't come near that. I think that's what's going on. What's up, bro? Just you can't see, right? How can I show you? I don't want to disturb the camera. I'll do this one. I'll show you. I'll show you the lizard. There is throw it cam. Yeah, I'm trying to get the my phone camera opened in OBS. Your capture device. Hey, why is it not showing up? Droid cam OBS. Real. Okay, it should work. Let me check. No, it won't work. I need to change the IP. Okay, now will it work? Okay, it's working, right? Yeah, I'll show you. Now let me just fix this on the done and hello. Hey Tim, what's up, bro? I'll show you. There is some gang wars happening between lizards over here, bro. I just want to show it in chat. Okay, so you can see, right? One lizard is here. The other one, I think it went down, and they both were fighting. They were fighting like near this and all. So usually around the light, right? Around the light, they'll be around the light usually. But whenever I'm streaming, I think because of these two also has light sources available, they are confused. I don't know. They're confused about their territory apparently, and they're fighting for that. I just want to show you that. Okay, next time when they fight, right? I'll show. we'll have we'll have illegal lizard fighting competitions. I'm not making them fight, right? They are doing it on their own. I'm not doing anything to them. Are you playing game today? A nice keyboard. Thanks, my nice keyboard. Yeah, yeah. This is the keyboard. Which one is this? I forgot its name. It's an HP one. It's not a fancy one actually. It's much very less expensive. Yeah, there is RGB, but it's not dynamic. It's an HP keyboard only. And games, no, Tim. I'm not doing. Yeah, we are reading book, bro. We are pivoting towards educational and a book reading. Okay, I won't say educational. We are moving towards a book reading channel from a gaming channel. Okay, where were we? The transition to fiat money. Fiat money is a currency that derives its value from government, regulation, or law. We didn't read this, right? Rather than being backed by a physical commodity such as silver or gold, The transition to fiat money began in 20th century with many countries abandoning the gold standard as the basis for their currency. I see, I see. Yeah, man. So, the evolution of money, that's what we are learning today. One of the main advantages of fiat money is its flexibility. Governments can more easily control the supply of money and adjust interest rates to respond to changes in the economy. This flexibility is particularly important during times of economic crisis when a country may need to quickly inject money into the economy to stimulate growth. However, the transition to a fiat money has also been met with criticism. Some argue that the fiat money lacks intrinsic value and is susceptible to inflation, as governments can print more money without being backed by a physical commodity. This can lead to a loss of confidence in the currency and decrease in its value relative to other currencies. Furthermore, the reliance on the fiat money has led to an increase in debt as governments can borrow money more easily without the need for gold or other physical commodities to back the loan. This can lead to economic instability, particularly if a government's debt becomes unsustainable. Overall, the transition to fiat money has both advantages and disadvantages. While it has provided greater flexibility for governments to respond to economic changes, it has also led to concerns about inflation and debt. Wait. Nothing. Okay, so usually, yeah, in the other book, right? I usually kept like topics under 10, but this has like 13, 14, yeah, 13 topics. Maybe it's because of the first chapter. Let's see. No, no, not first, like the initial chapters. Yeah, I remember like towards the end, the chapters become much less, they become small or much less elaborate. They become more brief. I purposely did that. Okay, guys, some random keys have been pressed. Is the stream still working? It's fine, right? No, no, I'm like paranoid from the last stream when like it accidentally muted itself and I've been reading the book and no one was hearing anything. I think it's fine. Okay, the impact of digital currencies on the evolution of money. The advent of digital currencies has sparked a revolution in the world of money, challenging the traditional forms of payments. Digital currencies or cryptocurrencies such as Bitcoin, Ethereum, and Litecoin are digital assets that operate independently of a central bank and are secured by cryptography. These currencies provide a decentralized and transparent financial system that allows for faster, more secure, and cheaper transactions. The emergence of digital currencies has significant implications for the future of money. One of the main advantages of digital currencies is their global accessibility, allowing people to transact with anyone, anywhere in the world, without the need for a third party intermediary. Additionally, digital currencies provide an alternative to traditional financial systems, which are often subject to political and economic instability. However, digital currencies are not without their challenges. The lack of regulation in the digital currency market has raised concerns over security, fraud, and money laundering. There have been instances of high profile hacks of digital currency exchanges, resulting in significant losses for investors. Despite the challenges, the growth of digital currencies is expected to continue with more and more businesses and individuals adopting them for everyday use. The impact of digital currencies on the evolution of money is undeniable, and it remains to be seen how the technology will continue to transform the global financial system. Subish, don't get mad. Like, why will I get mad, bro? What's up, man? Yeah, the lizard, right? I think he's like playing the game of freeze. He's statue, the game of statue, right? He's just frozen over there. I think he's like wait, the other guy, where's the other? So usually that's what they do, right? They'll just do the Mexican standoff. The two lizards will be facing each other. Whoever moves first, the other one will attack or something like that. Okay. Yeah, the future of money and its potential evolution. The future of money is an exciting and rapidly evolving topic. As technology continues to advance, so too does the way we think. So too does the way we think about money and use money. One potential future for money is the widespread adoption of digital currencies such as Bitcoin, Ethereum, and other cryptocurrencies. These currencies operate on decentralized blockchain networks, allowing for fast and secure transactions without the need for intermediaries like banks. Another potential future for money is the rise of digital wallets and payment systems. With the increasing use of mobile devices and the internet, people are turning to digital payment methods for their convenience and speed. Digital wallets allow users to store their payment information in one place, making transactions easy and fast. In addition to digital currencies and payment systems, the future of money may also see a shift towards more sustainable and socially responsible investments. Consumers are becoming more aware of the impact their financial decisions have on the environment and society and are looking for ways to align their values with their investments. Overall, the future of money is likely to be shaped by technology, innovation, and changing consumer preferences. While it's impossible to predict exactly what the future of money will look like, it is clear that traditional forms of currency and payment methods will continue to evolve and adapt to new technologies and social trends. So that was the evolution of money. Wait, Subish, oh, yesterday 1:22 a.m. I was watching BTC, but instantly it got to $1, and I bought 0.007 BTC in 1250, price change to 100k. I am rich now. I can buy unlimited bond coin. Okay, I don't know what you're saying, Subish. How did you buy Bitcoin? Wait, no, my question is how did you buy it? Okay, first of all, I know you're lying. Second of all, nice story, bro. Imagination. Huh? Why did you say like don't get mad? I don't see like why you telling a story will make anyone mad. I mean, okay, chapter 4, debt money system, origins and mechanisms. Definition of debt money system. A debt money system is a monetary system in which the majority of money in circulation is created by banks and financial institutions through the process of issuing loans. This means that the money supply is created through the creation of debt, as opposed to being backed by a commodity such as gold or silver. In a debt money system, the money supply is primarily composed of bank deposits, which are created when a bank extends a loan to a borrower. This type of money is known as credit money and is essentially a promise to pay backed by the borrower's collateral or the bank's reputation. In a debt money system, the value of money is not fixed but rather determined by the perceived creditworthiness of the borrower and the lender. The system is built on the assumption that borrowers will repay their loans and that the banks will be able to recover their loans in full with interest. This system can be highly profitable for banks as they earn interest on the loans they issue, while the borrowers benefit from access to credit. The debt money system is the prevailing monetary system in most modern economies and has been in use for several hundred years. Its proponents argue that it provides an efficient way to create credit and promote economic growth, while critics argue that it can lead to financial instability and wealth inequality. Uh, wait. I swapped Sol for BTC. Yesterday I earned zero point 0.8 in an application. After I get $5, I can transfer it to BTC. Okay. I don't believe you, right? I don't believe you when you say you swapped Sol for BTC. Okay, first of all, all you had was Sol. All you had was 0.005 Sol in Solana network. And it's not connected to BTC in any way. Probably you bought some shitcoin, bro. Okay, Subish. Yeah, I don't know. I don't know what to tell you, man. Okay, guys, we'll discuss further, right? We'll discuss further about different networks. We'll discuss about bridging and swapping. I don't even know how you got that word. We'll discuss further and like how we can do things in a more organized and controlled fashion, and don't just randomly buy shit coins. Okay, first of all, you don't even know what shitcoin is. You don't know where to get shitcoin. Okay, you swapped Sol for BTC. Explain. Where did you swap BTC? Where did you swap Sol for BTC? I don't care. Now I have infinite money glitch. I mean, if you think you have infinite money glitch, good for you, Subish. Good for you. Oh my god. Yeah, see, this is another thing, right? So, Bish, the most important lesson, and the first lesson you should learn is there is no such thing as free money, and there is no thing such as money glitch or infinite money glitch. It is not there in Telegram. Yeah, good, good. Okay, good. You found some shady Telegram group which does scamming. Good job. Yeah, man. Eventually, you will become a millionaire. Not millionaire. You will become billionaire, bro, through the Telegram. Yeah, yeah. Guys, don't randomly go through any Telegram chat and do any trade or send money to anything. It's all a scam. It's all a scam. I mean, already know that. Subish, you already know that. I mean, I guess you are like exploring things, which is good. Like exploring it is good, and exploring things with your 0.005 soul is fine. It's actually fine. The maximum you can lose is the 0.005 soul, which is not that significant, so it's okay. But don't put in real money to do this shit, guys. Not just Subish, anyone. Don't put in real money to go through random scam Telegram groups. I want to buy Bonk coin. It's it only worth $11. Subish, see, in that particular sentence itself, there are so many things which are wrong. Okay, wait, let me show you. Bonk coin. Okay, so Bonk coin, right? So can you see the screen? You can see the screen. Fine. Okay, so Bonk coin, one Bonk coin is currently worth 0.0002357 dollars, and it is currently in. Wait, is it not in Solana? It's in Solana, right? Yeah, it's in Solana. But why does it show? Okay, maybe it's there in different contracts. Okay, fine. But it's there in Solana. Okay, so in this contracts you can go and see the original address, like the contract address on Solana. So you copy that so that you won't randomly buy some. I'm gonna buy more Sol today. Don't do that, Subish. Don't do it. Don't, don't. Subish, don't get into the. Okay, don't at least put in your own. Don't put in real money to do this shit. That's all I wanna say. Okay, so now you go to uh, a swapping. Oh, okay. No, no. Before that, you can see right where it's available. The market for Bong. So these are the Bong markets. So these are all centralized exchanges like Binance, right? Binance, Bybit, Coinbase, and all are centralized one. So in that we have the option to see this is CEX and DEX. So SEXs and DEXs. So DEXs are decentralized exchanges and SEXs are centralized exchanges. So we want to usually do with decentralized exchange. You can't stop me. I mean, I can't stop you. See, remember that, right? I can't stop you and I can't make you do anything also. I can't make you do make you do anything, or I can't stop you from making doing anything. So understand that. That's all I want to say. Okay, so now we want to actually do on a Solana exchange. So the one which, so this one is the different one. This is also Solana, but it's, I don't usually use that. Pancake Swap is for Binance. Uniswap is for Ethereum, and this one is also Binance. So you want to go to Radium. Radium is a exchange. So make sure you are going to the right Radium site, because if you randomly search in Google, you will come across some scam sites. So don't go through that. Go through like Coin Market Cap, and this is the original Radium swap. So in that we will sign with our Phantom, right? Yeah, Subish, another way I know you are not going through any real exchanges, because you don't have a laptop. So you do need a laptop to access all the decentralized applications. You can't do that through phone. Okay, so right now the my wallet, right, which I've made before. So this wallet have 0.005 soul, which is worth this much. Okay, the worth is doesn't really matter. So in that I can use it to buy the thing, which was that Bong coin, right? Yeah, Bong coin. So let me get the contract again. Copy this, then go to Radium and search. So you can see. So this is the original Bong, which has the value. If you just randomly search for Bong, like typing it Bong, you won't get the real website. You can just search 9FBR, you will get good website. Don't do that, guys. Don't do that. Subish, you also don't do that. Okay, so now in this, let's say for 50% of the. Oh wait, I don't think I don't think I have enough soul to even do the trade. You need at least 0.01 soul to pay for fee and deposits. Yeah, so I don't have enough thing. I don't have enough balance, right, to even do a proper trade. But if I were to pay 0.001 soul, if I had more soul balance, I can do the trade. Then I'll get 9,994 bone, which is worth, like, in terms of dollar, it's like the same worth. It doesn't matter. But I'm saying, so this is how you safely do the trading in Radium using Solana. But BTC, right? BTC you can't buy in this, because BTC and Solana are like entirely two different networks, which are like in a way connected through some bridges, which is like very complex topics which we can't discuss now. Okay, so now, okay, you know what? Let me just show you how to buy Trump coin. Similarly, okay, so go to Coin Market Cap and find the original official Trump coin. Don't just randomly buy coins which you find the address in some shady websites. This is like the original one. Okay, copy this. Now go to Radium and search, and you will see the official one. So in this one also, I can't buy it because I don't have enough balance to buy it. So this is how you buy it in the thing. Example 9FBR, Sunny DD, new video. Holy, I was getting scammed. What the hell? Uh, so Bish, I don't know if you're being sarcastic or not, man. Like, okay, fine, whatever, it's okay. Yeah, so this you buy the Trump coin. If you had like soul in your Phantom wallet, then you can use it to buy it. I mean, but I'm not gonna connect my like real wallet in this. I don't want to show. Like eventually I'll show you guys. Like when we do the uh, workshops, right? Then I'll show how to access all these applications. Like the first one is Coin Market Cap and Coin Gecko. Then I'll show you the things for swapping, like the Radium and other exchanges. Give me link of Coin. No, no, I don't have to give you anything. See, this is the problem, Subish. Don't ask anyone to give link for anything. And whoever in the chat also, don't just randomly click on any link in the chat. You can, like, the official thing is go to coinmarket.com, which is like the which you can search in Google and get it. And in that you will find all the official links and official contracts of all the coins which you want. So in this also Bong, right? Bong is here. Bong is actually on number 61, and it's based on the rank is based on the coin market cap. So this is the original one. You trusted person. No, I'm saying don't randomly trust anyone on the internet, even me. That's what I'm saying. You can do that on your own. This is one of important thing I'll teach you, which is DYOR. Wait, DYOR, bro. DYOR. Today I'll phone call you. Yeah, don't do that, bro. Okay, the first and the most important thing you have to know in crypto is TYOR, which means do your own research. See, one good thing about crypto is that none of nothing, like no contract, no information is private. Like everything is available public. So you don't have to rely on some like random telegram group or random guy on the internet to get your information, right? So that's one important thing. So that's what I'm saying. See, even for the coin data, all the data and all the contracts and all, you can go through legitimate sites like coin market cap and get all the things so that you won't get scammed. That's the thing. I am buying data for calling you, you must pick up. Yeah, there is nothing called you must pick up. I'm not going to do that. So see, this is one way we can communicate. We are communicating, right? We are communicating through chat, which is fine. But yeah, sorry bro, I don't pick up like calls. I mean, when I say I'm sorry, I'm not actually sorry. I'm just being polite. Yeah. Bro, how many? I don't know how many numbers I've blocked so far. I don't know. I think I can see it, right? I'm not even blocking it, right? The app which like prevent like some scam calls and unknown numbers and all, is just automatically getting scammed. You should make video explaining this. You will get good views. I know that, but I don't want to do it. See, already like good videos are there. That's what I'm saying. I'll do content related to this, but I won't make videos. We'll do workshops, like live workshops, like on stream, which is better. Yeah, we'll do that. I have plans, right? I'll have plans. Unblock me. Yeah, not gonna happen, bro. I don't know. I don't even know which is your number to unblock you in the first place. That's the thing. I have like so many like scam calls and uh, things and all are blocked, right? I don't even know which is your number to unblock you. Even if I know, still I won't unblock you. Why did you even call in the first place? Yeah, guys, don't call any random number. That's another thing. If someone like gives a number saying this is the number of that guy or this guy, don't just randomly call on to phone numbers. That's like unsafe. First of all, that is like unsecure in from your part, which is I'm saying it's unsecure for you, and even if it's the real number, it's unsecure for the other guy. So don't do that. Okay, so let's continue. Do your own research, guys. Do your own research. So every information related to crypto, right? Everything is publicly available, so you don't have to rely on random guys on the internet. You can just do your own research. So where are we? Yeah, debt money system. So yeah, we are discussing about debt money system, its origins and mechanisms. Chapter 4. Debt money system. Origins and mechanisms. Yeah, definition we read, right? Yeah, the definition we read. Next is historical background of debt money system. Debt money system has a long history, dating back to ancient civilizations where people used to borrow commodities such as cattle, grains, and precious metals. These commodities were lent with an expectation of repayment, often with interest. However, the modern debt money system as we know it today emerged during the 17th century when the first banks were established. One of the earliest forms of debt money system was the goldsmiths system, where goldsmiths used to store people's gold in their vaults for safekeeping. Over time, goldsmiths began issuing paper receipts for the gold, which could be used as a form of payment. These receipts eventually became the first banknotes, which were backed by the gold reserves held by goldsmiths. As banks began to grow in power and influence, they gradually transitioned from being mere intermediaries between savers and borrowers to being creators of money. The process of fractional reserve banking allowed banks to lend out more money than they had on reserve, creating new money in the process. This allowed banks to expand credit and spur economic growth, but also made the system vulnerable to run and panics. Oh, vulnerable to runs and panics. Runs in the sense like bank runs. Yeah, they were talking about bank runs. Today, debt money system is dominant monetary system in the world, with central banks and commercial banks controlling the supply of money and credit in the economy. Next, the role of central banks in debt money system. With how to log on that website, Mr. Gino read chat. I got only 9% charge. Bro, recharge the thing, recharge your phone. What do you mean, like, how do you log into the website? You mean, like, Coin Market Cap? You don't need to log into Coin Market Cap. Or are you talking about Radium? Radium, you can only log in through a laptop. Yeah, that's what I'm saying, right? All the decentralized applications for, yeah, every like all the decentralized applications, like even for Bitcoin, Ethereum, and even Solana, like everything, you need a browser, you need a laptop. You can't do it through phone. You can't log in it through phone, man. Yeah, or are you talking about Coin Market Cap? Market Cap, you don't need to log in. You can just simply use it. I'm not logged in. Right? You can't see it, right? Yeah, this one you don't need to log in, man. Yeah, see, I'm not even logged in. You can just simply use it. Yeah, two important sites. Well, let me put it in chat. Coin Market Cap and Coin Gecko, because both are like similar, but their interface is a bit different. And some people prefer Coin Gecko, some people prefer Market Cap. It depends on their preference. Like whatever you started using, you will eventually learn the interface better, right? So it's fine. Both are fine. I'll send you the link. This is Coin Market Cap and this is Coin Gecko. The important thing is that this is like a safe space where we can find the contracts and the data and so many things. Like there are so much information, but the initial thing is find the legitimate coin contract and see which markets and decentralized apps they are trading in. So how to search coins? Oh, this here. Can you see this? You can see it, right? Yeah, on like there's a search bar. So this you can access through phone. Yeah, this one you can access through phone. So in this you will actually see what is the current price, what is the current trend, what is trending now, how much is it selling for. So many information, so much information. Just to navigate coin market cap itself will be like a, I don't know, so much time. And every day you will learn something new. That's another thing. That's with everything, right? That's with life as a whole. But still, like in coin market cap itself, even if you like understand like all the things, still you will see so many things are there to learn. Oh wait, guys, it's seven. It's seven. It's seven. Okay, guys, I'll end the stream. And this was a, yeah, we finished Capital Game, which was good. Now we started Currency Conundrum, and yeah, guys, I'll end the stream for today, and tomorrow we'll continue this, and eventually we'll finish this, and the future is decentralized. Then we'll do our workshops and all. Fine. Chalo. Subish, why ending? Huh? It's time, man. It's time. It's 2 hours, 20 minutes I've been streaming for. So, yeah. Chalo. I'll see you later, bro. So, I'll buy Solana. No, no. The thing is, I'll buy Solana. Okay. So, first of all, for you to buy Solana, you need real money. That's how it works. If you don't, if you are poor in real life, you are poor in crypto too. What do you mean you will buy Solana? You need real money to buy it, right? You will need real. I got $0.28. Yeah, you can't buy Solana with that much money. The there's like minimum things. Okay, I'll tell you. I'll show the things. What is it? How to get your fiat currency into crypto. I'll talk about that further. But you can't just simply buy $0.28 worth of Solana and transfer it because there are like some minimum criteria. Wait, yeah, that is, you don't even know what I'm telling you right now, right? Like converting fiat into crypto. You don't understand what fiat is in the first place. Yeah. So, which it's fine, man. You won't understand it, bro. Eventually, you'll understand it. See, we actually discuss about all these things. There are like so many terms and all you need to understand. How to bridge from real currency to crypto through, I'll buy BTC, swap BTC for Solana. Again, to buy BTC also, you don't know. It's fine. So, you are rushing through things, man. You are rushing through things. See, you can just instantly know everything as a like in this instant. You can't. There are so many things you need to learn. You can't just go on. You can't simply go to read a book without learning ABCD, right? So if you don't understand that with that simple analogy, then I don't know what else to tell you, man. You are lost. You are lost in life. Hello guys, I'll see you all tomorrow. We'll continue with debt money systems, huh? Chalo. Killing rampage. Bye guys. Bye. Bye.